Hello students, hope you will like and understand the content of this video. If you have got any query, please send it through the comment box. If you like Smart Lectures, please subscribe, follow, like, comment and share our channel. Thank you very much.
Episode 5, Financial Statements with Adjustments. Let's take one more question. This is the trial balance as on 31st December 2017. Opening stock as on 1st January 2017, 1000. You know, opening stock means the stock in the beginning of this accounting year. Our books are closed on 31st December 2017. It means our accounting year begins on 1st January and ends on 31st December every year. In some companies, in some countries, firms, the accounting year starts on 1st April and it finishes or ends on 31st March. In our question, our accounting year is 1st January to 31st December. So opening stock means as on 1st January 2017, 1000 purchases, 2000 sales tons, 100 freight inward, 200 interest on short-term loans, 700 accounts receivable, 4000 building, 1000 patents, 2000 capital, 2000 sales, 4000 purchases, returns, 300 short-term loans, 1000 bank loan, 2000 commission, 700 reserve fund, 1000 total 11000 on both sides. And adjustments means the additional information below the trial balance. Closing stock 300, depreciation on building 100. Be careful, this closing stock is as on 31st December 2017, that is 300. So next adjustment is depreciation on building 100, manager's commission at the 10% on profit before commission. It means we have to provide commission to the manager at the rate of 10% of the profit. Which profit? Before calculating this commission. So let's prepare the format of trading account, profit and loss account and balance sheet as usual. So first of all, we'll take up adjustments. Closing stock 300. On the credit side of trading account and on the debit side of balance sheet, means asset side. Then depreciation on building 100 rupees. You know what is the journal entry of depreciation? That is depreciation to building 100. You know, depreciation is an expense. It reduces our profit. And number two, it reduces the value of that asset. So journal entry is depreciation 100 to building 100. Depreciation will go to the debit side of profit and loss account, and to building 100 means it will go to the credit side of balance sheet, means liability side. But building cannot be taken to the liability side, so it will be taken to the asset side but will be deducted in the inner column. So what is the value of building in the trial balance? That is 1000. So write down building 1000 in the inner column minus depreciation 100. In the outer column, it will be 900 rupees. Then manager's commission. The journal entry will be manager's commission account debit to outstanding manager's commission. Because if we calculate the commission today, it will be paid next year, means 2018. Naturally, it will become the outstanding expense. So manager commission account debit, this is an expense. It will go to the profit and loss account debit side. And to outstanding manager commission, this is the liability. It will go to the balance sheet liability side, outstanding manager's commission. But at this stage we don't know the amount of manager commission. It will be calculated later on, so we can leave the space for amount. So in this way we have taken up all the adjustments. Now come to the trial balance and take all the items one by one. Always be careful. Each and every item of the trial balance will go to the financial statements, means you can't skip any item, and debit side will go to the debit side and credit side will go to the credit side of financial statements. So opening stock 1000 on debit side of trading account, purchases 2000 on the debit side of trading account in the inner column, sales returns 100, it will go to the credit side of trading account in the inner column. Freight inward 200, this is direct expense, so it will go to the trading account debit side. Interest on short-term loans 700, it will go to the debit side of profit and loss account. Accounts receivable, this is an asset. Accounts receivable means this is the total of debtors and bills receivables, so it will go to the balance sheet asset side. And one thing more, this is current asset. And then building 1000, it will go to the asset side of balance sheet. Patents, it is an intangible asset, will go to the asset side of balance sheet. Now come to the credit balances. Capital 2000 in the inner column in the balance sheet. Sales 4000, it will go to the credit side of trading account. So 4000 minus 100, 3900 in the outer column. Purchases returns 300, it will go to the debit side in the inner column. So 2000 minus 300, 1700 in the outer column. Short-term loans, this is the short-term liability, it will go to the liability side of balance sheet. Bank loan, this is the long-term loan liability, it will go to the liability side of the balance sheet. Commission 700, this is income, it will go to the credit side of profit and loss account. Reserve fund 1000, it will go to the credit side of balance sheet, means liability side of the balance sheet. Reserve fund is nothing but a general reserve, means this is an accumulated profit. If there is any accumulated profit means the firm has made the profit, but it has not yet been transferred to the capital. If the firm invests money equal to the general reserve somewhere, then that general reserve becomes reserve fund. Reserve fund means general reserve accompanied by some investments, means the same value of investment. So it is the item of the liability side in the balance sheet. So in trading account, that will be to gross profit 1300 and the total on both sides 4200. Profit and loss account, gross profit 1300 and the total on credit side is 2000 and the total on debit side is only 800 because two items are there, 700 and 100. So it means still we have to calculate manager's commission, but without commission the profit at present is, without commission means the profit before commission, that will be 2000 minus 800, 1200, means at present without commission the profit of the firm is 1200, means this is the profit before commission, and we have to calculate 10% of the profit because it has been clearly written in the adjustments, provide manager's commission at the rate of 10% of the net profit before commission. So the profit before commission is 1200, so to outstanding manager's commission at the rate of 10% on the debit side will be 120. We had already left the space for amount, the amount will be 120. So what will be the net profit? 1200 minus 120, that will be 1080, 1080, and the total on both sides 2000. In this way we calculated a rough profit on rough notes without considering manager's commission, and that was 1200, and we provided manager's commission at the rate of 10% of 1200. Means 1200 is the profit before commission. Be careful, the net profit after commission is 1080 now. This is the net profit. It will go to the balance sheet. So 2000 added to 1080, in the outer column 3080. And outstanding manager's commission, that will be 120 on the liability side, because this manager's commission will be paid next year in 2018. So total on both sides 7200. So in this way, if there is manager's commission, first of all, it will be taken to the profit and loss account debit side. Secondly, it will become the liability for the firm. And if there is depreciation, number one, it goes to the debit side of profit and loss account, and number two, it goes to the asset side and reduces the value of that asset in the balance sheet on asset side.